is a video for when a lessor creates or enters into a capital lease and when the lessor has to account for it as a sales/financing lease. Now, before we go on into understanding sales and financing leases, it is probably prudent to again review the background of when a lessor has to decide whether or not a lease is going to be accounted for in a certain way. They have to determine whether or not the lease is either a capital lease or an operating lease. And the criteria for a lessor is pretty much the same as the lessee, where in effect the presence of any of the following attributes in the lease agreement or any side agreement, if these are present, one or all, in the lease or the side agreement, the lease would be considered a capital lease to the lessor. Number one, it provides for a transfer of ownership. Number two, it provides a bargain purchase option, BPO. Number three, the lease term is for 75% or more of the leased asset's economic useful life. Or number four, the present value of the minimum lease payments are at least 90% of the fair value of the leased property at the inception of the lease. So if any of these particular criteria exist, the lessor will most likely consider this a capital lease. However, the lessor must also ensure that the lease meets the additional two following criteria in order to be a capital lease. Number one, the collectibility of the payments are reasonably predictable, and number two, there are no material uncertainties regarding reimbursable costs to be incurred by the lessor. So in this case, if at least one of the four criteria are met initially and then the other two criteria are met, the lease then would be considered to be a capital lease. And when we look at capital leases, we have to basically determine which lease accounting is appropriate. We have two types of lease accounting for capital leases for lessors. The first one is what we call a direct financing lease, and that is where the lessor's economic interest is in actually financing the asset. And the other one is called the sales type lease, and this is a lease where the lessor's economic interest is actually twofold. The lessor is looking to make a profit in selling the asset, and then number two, financing the asset itself. So let's take a look at the next slide and see delve a little bit more into direct financing and sales type leases. Now, in the case of a direct financing lease, again, the lessor has no economic interest in the transaction other than financing the purchase. Typically what happens is the lessor, the leasing company, buys the asset from a vendor and then leases that asset to the buyer, who is a lessee. So the revenue in the transaction or for the lease is derived from the interest income on the lease. Now if we take a look at the sales type lease, the lessor sells and finances the property. So in this case, the lessor, the company, sells the asset to the buyer, who's going to be the lessee, and provides financing through a lease to the buyer, who's a lessee. So revenue is derived from number one, the gross profit associated with the sale, then number two, the interest income on the lease. Now we're going to go through the accounting for a sales type of lease. The next slide you're going to see looks relatively complex, but after you take a look at it for a few minutes and understand it, it's really not that difficult. So let's move on to the next slide. And what you see over on the left here are two major journal entries, and you can see the first journal entry is debit cost of goods sold and credit asset. This is a journal entry when we initially set up the lease. We then convey the asset, we take it off of our balance sheet, our books, and then it's moved to cost of goods sold to indicate that we have actually sold the asset as part of the lease agreement. The next part then is the information regarding the lease itself, the amount of lease payments that we're going to receive, the unearned interest expense, which will eventually be amortized I'm sorry, the unearned interest income that will eventually be amortized into interest income over the life of the lease. And thirdly, we have to account for the sales revenue because we're also selling the asset. So let's take a look at where we record cost of goods sold. And again, this is like a normal sales transaction in any type of company, because what we have is the asset, and the asset is going to be at its carrying value, or the inventory value, whatever you want to call it, the carrying value of the asset. And when we sell it as part of the initial lease, that asset then is going to be transferred to cost of goods sold, just like we would with any other type of merchandise or inventory item. Now, in the case of the asset sold, again, it's the carrying value of the asset. When we calculate cost, or when we record cost of goods sold, it's the carrying value of the asset sold minus any unguaranteed residual value of the property, if that exists. Okay, our second journal entry then records all of our lease payments for the entire lease period under lease receivable. Then we're also going to record the interest income that we are going to receive from the lease over the period of the lease. And the last item is an entry that will record our sales revenue, which will be matched against our cost of goods sold. So let's start off with the debit to our lease payments receivable. The lease payments receivable is also called the gross investment in a sales financing lease. And this is our total minimum lease payments over the term of the lease, plus any unguaranteed residual value of the property. So our gross investment is the total minimum lease payments over the term of the lease plus any unguaranteed residual value of the property. Our credit then will be our unearned interest income, which will be our gross investment, which we just previously calculated. Our gross investment minus now the present value of our minimum lease payments, minus any present value of an unguaranteed residual value of the property. So that would be our unearned interest income. And lastly, then we would record our sales revenue, which is the present value of our minimum lease payments plus the present value of any guaranteed residual value of the property. Sounds pretty complicated, but let's try to simplify this just a bit. Okay, now we're going to use an example. And I told you I'd simplify it, and actually it doesn't look simplified, but the example is because we're using a real example in this case. So Zenas Manufacturing Company agreed to sell a machine to a customer and then finance it through Zenas' own leasing program. The customer, who is the lessor. Again, another big fuck up. Okay, Zenas Manufacturing Corporation, who is the, you gotta be fucking kidding me. Zenas Manufacturing Corporation, who is the lessor, agreed to sell a machine to a customer and finance it through Zenas' own leasing program. The customer, who is a lessee, entered into a 3-year lease agreement to pay $100,000 a year for 3 years. The machine sales price of the machine was $248,690. It cost Zenas $200,000 to actually make the machine. The implicit rate of interest on the lease was 10%, and the lease is considered a sales type of lease. The present value of an ordinary annuity for 3 years at 10% is 2.4869. So now we need to build the two separate journal entries of the sales financing lease, the initial measurement. And we're going to record the cost of goods sold first. So the first thing we want to do is let's take a look at the credit side. And the carrying value of the asset, it cost Zenas $200,000 to make the machine. So that's going to be the carrying value of the asset, the amount that the inventory value. $200,000. And also the carrying value of the asset is transferred also to cost of goods sold of $200,000. And in this case, there is no unguaranteed residual value mentioned in the problem, so there would be no unguaranteed residual value of the property. So at this point in time, then, our cost of goods sold would be $200,000, and the assets sold, the cost would be $200,000. The next item then is to record basically our lease payments, the amount of unearned interest income, and then the sales revenue associated with the lease. So let's start off with the lease payments. Again, we're going to calculate what we call the gross investment, and it is our total minimum lease payments over the term of the lease, which is basically $100,000 annual payment a year times 3 years. So the total minimum lease payments we have are $300,000. Now to that we would add any unguaranteed residual value of the property, but in this case there is no unguaranteed residual value, so that would be zero. So the gross, the lease payments then would be equal to $300,000. Next then, we want to consider the unearned interest income, and that equals our gross investment, which again is in this case, our basically the total minimum lease payments over the term of the lease, minus the present value of our minimum lease payments, which in this case will be $248,690. And we got that by the $300,000 times the present value of the annuity over 3 years at 10%, minus the present value of any unguaranteed residual value of the property, which in this case is zero. So our gross investment, or basically our unearned interest income, will be our gross investment of $300,000 minus the present value of our minimum lease payments of $248,690. So that becomes $51,310. This is the amount that will be amortized over 3 years to recognize the interest earned on the lease. The last item is the sales revenue, which is basically the selling price of the asset. And the sales revenue is equal to the present value of the minimum lease payments, which are, again, $248,690. And we had calculated that previously to calculate the unearned interest income. So the present value of the minimum lease payments was $248,690, plus we would add in any present value of guaranteed residual, the present value of guaranteed residual value of the property, which in this case is zero. So the total sales revenue would be $248,690. Now, there's a lot of boxes here, and you notice a lot of the boxes are zero because they deal with unguaranteed residual value, or in one case present value of guaranteed residual value. If we remove these boxes and forget about the residual value, what we see then is a much simpler calculation. Again, we take a look at the cost of goods sold calculation, and again, it's the carrying value of the asset. We take a look at our lease payments and our gross investments equal to the total minimum lease payment over the term of the lease, which is $100,000 per year times 3 years. We have our gross investment, again, which we just calculated previously, of $300,000 minus the present value of our minimum lease payments, and those happen to be our $100,000 minimum rental payment times the discount rate for an annuity at 10%, or $248,690. And our sales revenue is also going to be calculated at the present value of our minimum lease payments of $248,690. And why do we count that as revenue? Because the amount in excess of that is that $51,310 we're going to see is basically the amount of interest over and above the sales price of this particular item. So if you get rid of those boxes that talk about guaranteed or unguaranteed residual value, life looks a little simpler. And if the problem does ask for residual values, you can plug those boxes back in. Now let's take a look at this exact same problem without all the boxes. And now what we've done is, again, this is the exact same information. And what we've done is we've created the debit and credit. Again, in this case, Zenez sold a $200,000 asset. I called it inventory in this case, and cost of goods sold is $200,000. So we removed the inventory and basically moved it into cost of goods sold. We take a look at our lease receivable. It's 3 payments times $100,000 per payment. So our lease receivable over the life of the lease is $300,000. Our sales revenue then is the present value of 3 payments, or the present value of an annuity over 3 years, discounted at 10%. So the amount of the sales price we're assuming would be $248,690. The difference between the $248,690 versus the $300,000 is deemed to be interest revenue earned on the lease, and that's what we'll be amortizing every year with the lease payment. Now let's take a look at the amortization process for leases, for, in this case, a sales type of lease. And it's pretty similar to all the other amortization schedules you've been through with all the other leases. Again, we start off with an amortization. We're going to calculate interest being earned utilizing what we call the interest method. And again, we have our year column, which tells us these are the years ending, the beginning carrying value of the lease receivable, then the effective interest rate. We multiply the effective interest rate times the beginning net carrying value of the lease receivable, and we end up with, this is the amount of interest income that would have been created as a result of the carrying value of the lease receivable. Then we subtract out cash, which is the cash payment, and there's 2 ways this cash is going to go. It's going to go, number one, to satisfy the interest income, the $248,000 or $224,869, and the remainder is going to go to the reduction of the net investment, which would in this case be $75,131. So in this case, again, if we start out with year number one, the beginning net carrying value of the lease receivable is $248,690. We multiply that times our effective interest rate, or implicit interest rate in this case, which is 10%. So our interest income is going to be $24,869. So that's the interest income we're earning. Again, we're going to get paid by our customer. We're going to get paid $100,000. So the first $24,869 goes to the payment of interest, and then the remaining amount goes to the reduction of the lease principal, or the reduction of our net investment on the lease. So it would be $248,690 minus our interest, our $248,690 minus our reduction in our net investment of $75,131. So at the end of the year, after our first payment, our carrying value now would be $173,559, and that will be carried forward for year 2, and that would be the factor earning the interest for year 2, and so forth, all the way through year 3, where you see eventually the interest income keeps going down as our net investment decreases, and more obviously at a point in time where the net carrying value of our lease receivable at the end of year 3 is going to be 0. So if we were to produce a journal entry from year number 1, we would receive from the customer a cash payment of $100,000, which would be from our lease payment receivable. So that'd be $100,000 against the lease payment receivable. Also, we would debit the unearned interest revenue on the lease of $24,869, which represents the interest we've earned, and we would credit interest income of $24,869. Okay, I'm not going to produce the journal entries for years 2 and 3 because I think you probably get the hint or the iteration that the journal entries would be pretty much the same. The numbers would change a little, but we'd still be receiving cash. We'd reduce our lease payments by the $100,000, and then we would be recording the amortization of the interest revenue on the lease and count that as interest income. So let's go ahead with one multiple choice question on sales and financing leases. Number 1, Invesco leased equipment to a customer on July 1st of year 4. The lessor recorded the sales type lease, which is an 8-year lease, at $135,000, which was a present value of the lease payments discounted at 10%. The first of 8 annual lease payments of $20,000 due at the beginning of each year of the lease term was received and recorded on July 3rd of year 4. The lessor purchased the equipment for $110,000. What amount of interest revenue from the lease should Invesco report in its year 4 income statement? So again, this will take a few minutes. This will be a fairly complex problem, so take a few minutes to do your answer. Stop the video, and when you're ready, restart the video and review the answer. Okay, number 1, the question is, what amount of interest revenue from the lease should Invesco report in its year 4 income statement? In this case, the answer is C, $5,750. Now, we have to remember that the first of 8 annual lease payments of $20,000 due at the beginning of each year of the lease was received and recorded on July 3rd of year 4. In other words, a day or two right after the lease was entered into. Since the $20,000 payment was received at the beginning of the lease, no interest had really accrued. So there was no passage of time, so no interest accrued. So the initial payment is subtracted from the initial carrying value. It's almost like it's a down payment. So we have $135,000 carrying value of the lease minus our $20,000 initial payment. That means the carrying value in year 4 would be $115,000. So now we know with $115,000, we're going to basically subject that to our basically discount or interest rate of 10%. So it's going to be $115,000 times our annual rate of 10%. That means our annual interest is going to be $11,500. Remember though, this particular lease was started on July 1st, which means that we only have 6 months of passage of time until the end of the year. So the only amount of interest we're going to record is for 1/2 of a year. So $11,500 represents our annual interest. So we have to take a half-year interest. So we take our $11,500 annual interest, divide it by the 2 for the half year, and the half year of interest comes out to $5,750. And that's the answer to number 1. And with that, that is the end of our video on sales and financing leases for the lessor. So with that, again, thank you for your time.